Hey, everybody. Thank you so much for joining us. Super excited for our special guest today, Chris Miles, a cash flow expert in the anti-financial financial advisor. He is a leading authority teaching entrepreneurs and professionals like us how to get their money working for them today. He is an author. He is the podcast host of the Chris Miles Money Show, which I have been a guest on. He's been featured in U.S. News, CNN Money, EO Fire, Bigger Pockets, and has a proven reputation with his company, MoneyRipples.com, for getting his clients fast financial results. In fact, his personal clients have increased their cash flow by almost $300 million in the last 12 years. Chris, thank you so much for joining us and sharing with our audience today.
Hey, it's a pleasure being here, Seth. It's almost like deja vu, isn't it? I mean, we just did this 24 hours ago with your information and everything you're doing with the college, funding space and everything else. And here we go. We're talking about college financing again, aren't we?
Awesome. I can't wait.
Well, cool. Well, definitely I'm going to start sharing my screen here. Just kind of give you guys an idea of, what we're talking about today. Because obviously I want to be able to talk about what are some great ways for you to be able to find some way to save money in college better than a 529 plan. Because the 529 plans, they've been good to a point, but there are some limitations. I get a lot of people that have been reaching out complaining about their 529 plans, saying this just isn't working. I'm not getting enough out of this. I'm not seeing a big enough return. What if the market tanks and my kid is about to go to college? What do I do then? There just seems like just wasn't all it was cracked up to be. It was kind of overpromise and underdeliver on that sort of deal. So I really want to talk about some alternative ways to do that. And of course, if you haven't done so, I recommend you go and go back and watch the presentation that Seth did yesterday, especially if you're looking for not just getting scholarships, but getting funding from the colleges themselves, getting discounts on tuition. I mean, it's so amazing. If you can get the discounts and you can save well for the remainder that you got to save for, and if you can save in a place where they don't count it on the application for financial aid, that's exactly where we want to keep our assets. So that's what we're going to talk about today. All right, so let me go ahead and make sure this works. All right, it does. This is the fun thing about technology, is that I got to figure it out just like you all do. Some of you guys probably do it better than I do, though, so that's good. All right, so what's better than the 529 plan? Just a little about me. I do live in Utah most of the year, although we do snowbird in the wintertime because my wife's from the tropics. She was born in Venezuela, grew up in Florida, and I grew up in Oregon where it was milder climate. So she said, Chris, I can't do another Utah winter. I can't do more of the snow. Heck, we're getting snow today in Denver. I mean, come on. This is it makes you wonder if when summer's going to start, right? So for that reason, she said, Chris, we got to make sure we leave in the wintertime. So we go spend our winters anywhere south of here, anywhere that could be in the kind of the Sun Belt states of the United States. So we do that. We have a blended family of 8 kids. So talking about trying to worry about college, of our 8 children, 6 of our children are 12 and up. 5 of those are teenagers. So we got a pretty busy household. I'm not trying to keep them quiet right now. I just finished making them breakfast and everything. So we're like, okay, guys, keep it down. We're doing this. One thing that's interesting about me, I've been financially independent twice. I was able to become financially independent, meaning that I had enough passive income coming in that I was able to retire, quote unquote, in 2006. Then the recession hit. I went back in the rat race. I went over $1 million in debt, had to dig my way back out, and was able to become financially independent for the second time in 2016. So what's interesting is that, I come from a space of already being financially independent, but understand that also I come from a place of non-judgment because I've probably been worse off financially than almost anybody that's watching this right now. So I've been the deepest of lows, I've been the highest of highs, and everywhere in between. And so when it comes to money and the stress of it, I get it. And then, of course, our focus is on infinite banking, like we're talking about today. And we're going to talk about how that really works. And then, of course, cash flow consulting, teaching people how to get out of the rat race, how to work because you want to, not because you have to. So I want to start off here just to kind of share my experience, because when I wanted to go to college, and I know, Seth, you had a kind of interesting experience as well, just trying to have a dad that says, hey, I can't afford it. My dad preempted that. He said that not while I was in college. He said that all the way growing up. My dad was the kind of guy that says, hey, money doesn't grow on trees. What do you think I am? Made of money? We can't afford this. All those kind of scarcity
exactly
things.
Like my dad.
Yeah. I mean, he's working class, hardworking, good man, but obviously, even though he was saving, like Dave Ramsey taught everybody to do, right? Save everything, spend nothing, save it in your 401ks and pay off your house, which he did early. He was very proud of that. Yet he didn't have enough money to do anything else, and barely had enough money even for him to retire. Even when I met with him as a financial advisor later, I told him, I said, well, based on all that saving and hard work you've done and paying off your house, you can retire for 5 years. Congrats, Dad. So that's a whole other issue in and of itself. But he told me, he said, Chris, you're on your own. I'm not going to be helping you because I don't have anything to give you. I can't afford it. So I had to get creative a little bit. And the sad thing is, he said, hey, here's a big catalog. We'll pay $100 for it to get your scholarships. Couldn't get any scholarships, even though I put letters in. And he blamed me for not sending out enough letters, which might have been partly true. I didn't send out to everybody. I had 3 sports I was playing that year, so I didn't have all the time in the world. And I was working a part-time job. So I was trying to do everything I could to save and make it work. And so I ended up having to pay or go into debt for my college, which eventually I quit with 1 class before my bachelor's. So I'm actually a college dropout with 1 class to go. So I didn't even finish my degree. I'm not even using the degree of sociology I got my associates in. So that's a thing. And so I want to ask, have you answered this question for yourself is, are you really saving just for college, or are you thinking you're trying to save for the future in general? Because if you're like, my kids, some of my kids might go to college, some of them might not. Well, what do we do? Because these 529 plans only let you save for college and that's it. What if you want to save for something much, much more than just their college? So we're going to address that today too. All right. So here's the pros and cons, right, of 529 plans. We'll start here. 529 plans, the great thing is it can be used for some school expenses, including some private schools. I've had some clients use it for their private high schools and whatnot. And if it's used for immediate use, great. And sometimes even get a tax deduction. That could be a good thing. You can take advantage of stock market growth as long as the stock market grows. It's definitely a good way to kind of separate your money out if you're trying to save and create buckets. It's kind of a nice way mentally to have that easy place to set it and forget it. It is tax deferred. You can let that money grow tax deferred. I know I can already hear Seth saying, "Oh, there's a but. Oh, there's a but" with a lot of these, and of course there are. And of course, there are no annual limits, which is always nice too. You can put in a lot of money into these things, although some states most states will have a maximum you can put in. So they will stop you at around $250,000 to maybe 400,000 or so. It just depends on the state. So those are the pros. So it's not like it's horrible. It has a great concept, a great idea, but there are some cons to it too. One, if you don't use it for what they consider a qualified school expense, if you ever pull that money out, use it for something else or for emergencies or something comes up, or if they don't go to college and you got this money sitting there and you're not going to use it for any other kid, well, 10% withdrawal penalty, right? Now you get penalized on that money that has grown inside of it. It can be taxed when you move states, because a lot of times they defer the state tax, but if you move states, you could get taxed on that. As I already mentioned, there's market risk. Right now, we've already seen the stock market tank almost 20% year to date. If you're in that, what then? What if you lost 10 or 20% of everything you worked so hard to save for, only to lose it right as they're going to school? Limited investment selection. That's another complaint because people say, well, I have to, really, it's based on their age. Whatever you put your money into, that's where it's invested. You don't get a choice. It's going based on their age, and they put you in heavy in the stock market or not, depending on what's going on. Higher fees, which lowers your returns. There's higher fees than you would if you just saved it in a mutual fund on your own. Not flexible when plans change, of course. Like I said, if you decide to do anything, in my case, I dropped out of college. What if you have a kid that decides they want to be an entrepreneur? What if they go in more of a vocational trade that they can make great money and have a great career and it follows their passions and what they really want in life, but it may not require a accredited university to do that. Maybe it's more of an internship. Maybe it's more of an apprenticeship. Well, what do you do then, right? And of course, as we talked about yesterday, this money does get disclosed on your financial aid form. This does count against you as an asset when you're trying to qualify for getting help, when you're trying to get aid from colleges. Anything else you would add to that, Seth?
No, I agree 100%. The one thing, if I'm allowed, that you and I discussed yesterday is that the whole point of the 529 is supposed to be the tax deferred growth.
Yeah.
Well, how much did you put in the 529? How much did it grow? And what would have been the taxes if you had to pay tax on that growth? So even if you put in 25 grand and it doubled to another 25 grand and you're in a really high tax bracket and you would have paid $4,000 or $5,000 in taxes, did having that 50 grand cost you more than 5 grand in financial aid? And most of the times the answer is it cost you way more than the tax that you saved. So that's our biggest caveat is you're probably not going to save more in taxes than you're going to give up in financial aid for the privilege of doing that.
Good point. Yeah. That's a big one. I mean, it really, and this is, a lot of people don't even realize that. I've seen people already complain about their 529 plans before realizing, oh, wait a minute, this is not even worth it. Not is it my money not even growing enough, and there's an opportunity cost to that money where it could have been doing something better. But now I'm sacrificing what I could be receiving from colleges and universities of our choice had we not had this in the first place or had our money somewhere else. That's a great point. Thank you. All right. So what's better? Right. So let's talk about this. So we're going to talk about high cash value whole life insurance. Notice I mentioned high cash value because whole life is whole life. I'm not going to sugarcoat this. I hate it when people try to throw cool little names like the 7702 plan or, the cash flow banking or wealth formula banking or whatever they want to call it. Be your own banker. We talk about infinite banking in general because when we talk about this, what we want is we really want high cash value. Because what you may or may not know is when you buy life insurance, normally you're buying term insurance, right? It's just death insurance. When you buy it, you can only get paid when you die. You pay money in, and until you die, you get paid nothing. Where with whole life, the premiums are more expensive. It's almost like buying a home versus renting a home. You might pay more up front, but now you get this equity you can build. And you can do that here too, where you can build a tax-free savings account within the life insurance policy. So not only do you get a death benefit, but you also get a living benefit where you have this tax-free savings account that builds and grows in here at much better than the bank's 0.nothing% that you get paid. You can actually earn right now, most of them are paying between 5 and 6% tax-free. That gives you ability to save more money. But here's the thing. If you get a normal whole life plan, like what most people set up for you, they are very expensive and can be a waste of money. So we need to distinguish here because normal whole life plans, you pay in for the first few years, you have zero savings. Everything goes to insurance costs. So if you're paying in $10,000 a year to this plan, after putting in $20,000, you have nothing to show for it in that cash value. You have a death benefit, but you have no cash. The way we do it's different. You put in $10,000, you don't have zero in that first year or even zero in the second year. You put in $20,000, you'll usually have about $17,000 by year 2. And usually by year 6, you've got more money than what you've even paid in despite the costs coming out. So it allows your money to grow and build much, much faster than if you use a traditional whole life plan. So that's what we talk about when we want these high cash whole life insurance policies. So here's how they work. Because the thing is, like guys like the Dave Ramseys, they don't get it, right? The Susie Ormans, they rip on them like crazy. But again, they're talking about the traditional plan I just described, where you do have expensive costs, high fees. You don't want that because that just really goes to pay the agent's commissions and insurance costs, but it doesn't really pay anything to you in return. And so, but banks have been using this strategy for decades. In fact, they keep a big chunk of their cash reserves that they use to allow them to lend money. They keep it here because it's the safest place they can store it because there's guarantees and they can still grow their money. So tons of banks use this already. Why not us on the smaller scale, right?
There are also a number of Fortune 500 companies that use this as an executive retention plan to keep their C-suite executives around for 10 or 20 years as a kind of a form of golden handcuffs.
That's right. Yeah. A lot of times they base their pensions and things like that off of these. There's lots of ways to use it. Even more, even like famous examples. I know if you know JCPenney's, the department store, during the Great Depression, they used this to pay their payroll, right? When they didn't have a lot of money, they tapped into the reserves here to get their money. So they're able to access it quickly. We also have companies like Walt Disney. If you've ever heard of Disney, Walt Disney used this to actually purchase the land, to put the down payment on the land for Disney World in Florida, because the banks would not give him all the financing. He had to dip into his pocket and use some of the money from here to do that. And Pampered Chef, if you've ever bought their products, was started based on using this as seed money. So many, many examples of how people have been using this for years. GE used this, just like you described, to help pay pensions. Walmart was actually doing this so much that they were making a profit off of it, to where the government got mad at them and put some little handcuffs on the companies for buying life insurance on all their employees, because they were making more money than what the employees were, what the employees' families claimed they were worth, sadly enough. So anyways, so this is what we do. Again, you have money. Normally, most people just take money and they go and invest it, and then they create cash flow and investment. So if you take your money, you put a down payment on investment property, you create cash flow, and it comes back to you in your savings account or checking account or wherever you keep it. All we're doing is, instead of putting it back in your bank savings or checking, earning 0.nothing% and then getting taxed on 0.nothing%, and it shows up on when you try to apply for financial aid, instead we put it here where it stays hidden and it's tax-free. So in a sense, it's not hidden from the IRS, but it is hidden from being taxed, and it grows a lot better than 0.nothing%. And you can do much of the same things. It earns those tax-free dividends. And as we'll start to describe here in a minute, you can actually use this money to invest wherever you want. So you don't have to just say, well, whatever the 529 plan says that the money's going, that's where it goes. You get a choice to invest it wherever you want. Like I mentioned, it's tax-free. Here's another thing that's great. Besides from financial aid perspective for college, it's 100% protected from lawsuits and creditors in most states. I say most because there are some exceptions, like California. California has limited protection on this money. But in most states, if you could have millions of dollars in these plans, and if someone sues you and wins, they can't get to it. If there's a collections company and they win, they put a judgment or lien against you, they can't get to this money. That's huge, especially if you're trying to protect your money from the hands of other people. Like I mentioned, guaranteed growth. Many of them have guarantees of at least the ones we use, at least 3 or 4%. There's no stupid penalties or limits. So the cool thing about this life insurance plan is that it's much like a Roth IRA. You put it with after-tax dollars, it grows tax-free, comes out tax-free. But the problem with a Roth IRA, if you've ever used that, well, one, you don't want to use that for college savings, because if you try to tap into it before you're 59 and a half, they slap you with a 10% penalty, don't they? On top of that, there's not always that control. You may only be limited to putting in $6,000, maybe $7,000 a year into your Roth IRA plan. Or if you make too much money, they won't let you put money into a Roth IRA plan. Then you have to do all the different strategies like backdoor Roths and things like that to try to bypass all these stupid rules, making it complex and dumb. Guess what? You don't have to do that here. Here, we can actually make the limit whatever we want within reason. So, and there's certain things we'll talk about here about those limits, but there are no penalties. There's no early, 59 and a half rule you have to worry about. You can actually access this money within the first month of putting it in. So there's not that waiting period that you have to wait until you're old, if you even live to be that long. Hopefully you do, but we want to make sure we can access the money now when we need it. So it can actually even be an emergency fund for you, where you can put money in here, make better returns than you would keep it in your bank account, just trying to keep it for that rainy day. So there's lots of ways to use it. Bank leverage. This is the key if you're trying to use this with investing, is awesome. Right now, you can get lines of credit with certain banks as low as 3%. Now, here's something that's cool. Think about it. Now, what they do is they just use your money as collateral because they know it's guaranteed. It's safe. This is why banks, again, own it themselves, and then they use that as collateral to borrow as well, to be able to use that for leverage. Same thing for you. You can do the same thing the bank does, but in reverse. Because think about what a bank does. When the bank takes your money in the savings account, do they just let it sit on a shelf and collect dust? Of course not. They actually do something with this money, right? They're actually taking your money and lending it out to make a bigger return than what they pay you at 0.nothing% in the bank. You're just doing the same thing. You're now saying, hey, I can borrow this money at 3% from the bank. And guess what? I'm making at least maybe 4.5%, 5+% tax-free on this money, compounding interest tax-free, by the way, while you pay them 3% simple interest, which is a lesser interest that you're paying. So you're making at minimum a 2% spread, while you can take that money and invest it wherever you want. So I just taught this the other day that right now there's these savings I bonds, right, that you can buy through the US Treasury. They're at 9.62%. Well, you can make just 9.62% if you take that money from your checking, your savings, and put it in. Or if you have this money in your life insurance, you can take that money that you can borrow now, make it 2% spread on your money because you're making 2% more than what you pay the bank, and you make 9.62%, meaning you're making about 11.5 to 12% on your money instead of just 9.62. So cool little things you can do with this that you just can't really take advantage of anywhere else, not to this level, not to this degree, and not with this level of safety and protection and certainty. So that's a huge one right there. And yeah, even sometimes your local banks or credit unions will do it too. They might get you like a 4% rate, like around prime rate or something like that. Lots of ways to leverage this. And as I mentioned, you have access to cash today. So there's double arbitrage. I just described it, right? You're making a 2% spread. Maybe it's only 1%. Either way, you're making money over here and you make money over here at the same time. So let me use an example how that works. If you're going to invest outside, like if you're going to do real estate investing, and a lot of our clients will do that. A lot of them are looking to find ways to do something different than just the typical stock market investment. And so say you get a small rental. By the way, this is actually a real rental situation. This is actually a rental here that you see a picture of in St. Louis, Missouri. It's a $50,000 down payment when everything's considered. Cash flows $400 a month. It was actually a little bit higher, but I'm bringing it down to be conservative. Now, normally what you would do is if you want to put that $50,000 down payment on that property, you just pull it out of cash. You pull it out of savings, plop it on there, and then you're just making $400 a month. Now, what happens normally if you use a savings account? Say you have $50,000 in that savings account, you pull it out, you plop it on that property. How much do you have left in savings now? Zero, right? Because you just pulled it out. It's gone. So what do? That $400 a month goes back into your savings account to slowly build that sucker up, right? You're starting to slowly build that savings up so you can reinvest your money again. Now, if you did it that way, you're going to make a certain percent return. Here's what you're going to make after 10 years. Now, remember, you earn I'd actually this is 0.1% in the savings account, and you get taxed on that 0.1. And I put it at a low tax bracket. Some of you will be in a higher tax bracket, meaning you'll make less interest. Here's how much interest you'll make over 10 years in that savings account. $264. So over 10 years, you just paid back 48 grand. You finally just about got all your money back. And what did you make total? $264 of interest. That's all you made by replenishing that savings account. Because again, you're slowly building it and you're earning nothing on that money until it finally gets bigger. That's a 0.5%. That's a 0.5% return on your money over 10 years. It is not very impressive, especially when taxes get taken out. Now, what if you'd done that same exact strategy? You got that line of credit against it. I did this line of credit not at 3%, like I just told you. I did it at 4%. So you're paying 1% more than what I'm paying currently for my line of credit. So 4% while you're still earning returns on that. Now, say it's only about a 1% spread. Well, how much do you really make? Well, I actually used a real life policy to illustrate this and figure it out. The net you make, even after you've paid the interest back to the bank on that line of credit, because all you're doing now is taking that $400. Instead of putting in your savings account, you're using it to pay down that bank's line of credit. So you're just taking that $400 a month, paying down that $50,000 line of credit slowly over time. Yes, they're charging you 4% interest, but you're paying it down, which means you get charged less and less interest over time. While at the same time, your policy is growing more and more in interest. So you're earning money in the policy while paying less and less in interest. You start making a bigger spread. Now, remember, the bank was only $264. The life insurance, $20,000, $20,661.47 to be exact when I calculated it. So, you got to be exact, but I took off the pennies for you just to make it easier on the eyes. $20,661. That's a 41% return. Remember, you made $264 from the savings account. Over $20,000 with this. You made almost 100 times more using life insurance than just using your savings account to then invest. That's the power of that double dipping. That's all we're doing. Again, you're taking the cash flow, you put it into right there into that high cash policy. Well, that policy is earning tax-free dividends. So you're compounding tax-free dividends at the same time. You're paying down the simple interest on this loan. And so you get more than just that 1% spread because it compounds while the other one shrinks over time. That's huge. Even if you learn nothing else, right? Even if you learn nothing else about the college savings side, just understanding this you'll start to understand why this is such a no-brainer, especially if you're trying to do anything beyond college savings, even if you're just trying to do anything to help get a leg up financially for yourself and for more freedom for your family, more time to earn back for yourself. So you can actually be with that family before they don't want to be with you anymore, or before they're off doing their thing and living their lives and having their own families. You can actually have more time with them now by getting your money to create better leverage today. So that's how you make money twice. Now there's a few examples of this. Like, a lot of times people will talk about, well, I've got this person that does infinite banking. Well, just so you know, I'm not going to spend a lot of time on these numbers. One thing we guarantee is we can always design these better than anybody else out there. Even this guy that's really, really good, he's the one on the left, did great. And you put in 10,000, he had about 7,000 in there from day one. That's awesome. Well, ours have about $100 more from day one. Cool thing is, they're in year 7. By the end of that, even though we're putting in a few hundred bucks, about $100 less a year, they have 51,000, almost 52. We've got 60. So even though they look close, the thing is, in the end, we always end up having more money than anybody else out there. That's our guarantee. Is that there's no BS. We're actually going to show you real numbers. We're not going to complicate it, but we're always going to have the best numbers. Why not IULs? Like, a lot of times people will talk about index universal life, and that's starting to become a hot thing. I actually used to be a huge fan of these in the mid 2000s when I was that traditional financial advisor. I quit in 2006 when I realized that financial advising doesn't work. And I had to get away from the mutual funds and all the traditional way of thinking that hasn't got people to be financially independent. Well, IULs was one of my favorite. It was my product of choice because it didn't have all the market fluctuations. Well, guess what? There's some limitations here. One, you don't get that double dip. You can't make money twice. When you actually borrow the money out of it, although there's some exceptions, it's still very limited. Banks really don't want to lend against these because they're not guaranteed. So banks actually won't lend against them. So yes, you can get lending against it, but you'll pay higher rates, meaning you won't make really a good double dip effect there. Costs go up over time versus down, which whole life does. Whole life starts more expensive, but they go down over time. And like I said, there's no certainty. This is why I had to go away from them. When I started training other agents how they worked, I realized there's a lot of holes at these. And even people would argue, well, yeah, but index universal life, you'll have more money than a whole life policy. Well, not true. Here's one that a client sent us that said, hey, here's one we're looking at. What do you think? And I said, 12,000 a year that you can get. Notice after 10 years, they have $85,000 in there. Actually, that's accumulated. That's even the surrender value. In ours, 10 years, 142,000. So we still beat it by, almost $60,000. So even then, they still end up being more expensive, and they're not worth it because there's so much uncertainty and complexity. It's just ridiculous. Now, who is this not for? Who it doesn't work for? Obviously, this deals more with health than anything, right? Age or health. If you're pushing about 69, 70 years old, or you're not in great health, especially if you're like, I had a client who was like 400 pounds overweight and, great, in his mid 50s, loved the concept, wanted to do it, but he was just too heavy. Right. Or if somebody has medical histories and things like that might be limiting, like cancer recently and things like that, things that were life threatening. In his case, he was just overweight and had high blood pressure and cholesterol. So we didn't do it on him. Instead, we did a policy on his wife. Started putting $100,000 a year into his wife's policy instead. I've had other people where they've done it on their kids. They said, hey, I've got some insurance, but it's kind of expensive on me now. Can I do it on my kids? The answer is yes. You can actually put on each of your kids. Cool thing is you can't put as much money into your kids' policies, but usually you can put in at least 10 or 20 grand. And in some cases with clients that have more insurance on themselves already, they have a higher death benefit already on themselves. Your kid can't have more death benefit than you, obviously. So in the case where I have clients that might have at least a few $1 million of life insurance on themselves, we can actually sometimes dump in like $25,000, $30,000 a year into each of their kids' plans with some flexibility and such. So again, who's it not for? If you're a smoker, bad health, really, really overweight, not a little bit, but really overweight. If you're in a place where you're probably about 70 years old or older, this may not work exactly the way that you'd want it to. There would be different strategies that we would employ that way. But remember, you can get a policy on anybody in your family. You can get policies even on partners, people that you have a financial self-interest in, that kind of thing. Here's other ways you can use it. I mentioned emergency fund or reserves. In my case, my wife wants to keep $250,000 of cash that we don't touch. She's like, I don't want to touch it. I want to keep it just in case income, for whatever reason, like the world blows up pretty much, and our income goes to zero, despite all of our multiple streams of income. If that happens, I want to know we're covered. Okay, well, $250,000 sitting in the bank at 0.nothing% is not very exciting, is it? So what do? We keep a good chunk of that. We keep about 2/3, almost 3/4 of that money sitting in our life insurance, earning tax-free returns off the books, as Seth has said, with trying to get college financing, totally off the books as an asset. And then we just have a little bit in the bank that we can access, whether it be online savings accounts or whatever it might be. And that's the quick money we get to, because we know we can really, within a day or two, get to the money in our life insurance. So we keep a little bit in the bank for today's money, but we also have money in the life insurance, the bulk of it, to be able to make a better return than what we would earn. And think about it. If I made even a 4% rate of return better than the bank, 4% on $200,000, guys, that's $8,000 more a year that I'm making tax-free versus what I make in my savings account. That alone is huge. Cash flowing investments, like we just described here. I'll tell you an example of kids' savings that's down at the bottom there, since we're talking about the subject. I had a client, call him Dr. Phil. He's out in the Midwest. He had 2 boys, about 12 years of age. And he said, Chris, I want to start getting my kids to invest. He was already investing for himself, buying different real estates and investing in different things like that. He said, I want to get my kids to start building up their cash for their college. I said, well, let's see what we can do here. And so we started putting in about $12,000 a year into each of their plans. Now, the cool thing is, now $12,000 in the beginning isn't like a huge amount when you're trying to invest in real estate, but we can pool those kids' money together. So he's going in as partners with his sons, pulling the money together and buying properties or doing different types of investments that are paying returns and cash flow. And he's building that up quickly. So he's making a lot more money than he'd make in that 529 plan, building that cash so they have more than enough for college. So now is a great way to protect your money and keep it off the books for when you're doing this financial aid application. But it's also a better way to get more leverage than what you would get normally. So really cool ways you do it. And the great thing is there's no limitations. You can use the money for whatever you want. You could technically blow it on a vacation. You could blow it gambling in Vegas if you wanted to. No one's going to stop you. It's your money. You do what you want with it. But we definitely recommend, if you want this to work, use it for something that's going to work for you. I mentioned you can use it as collateral, just like Walt Disney did, using that as collateral to be able to get the land in Florida. And he has this dynasty today as a result. You can do the same thing. I had a client out in Minnesota where they actually used that as collateral for getting a very low interest loan on a building that they were working out of. They were business owners. They wanted to buy their own building and then rent it out. They bought their own building. They even got extra money from the bank for build out. So they actually got more money as a loan than what was in their policy. And the great thing is they got a super low interest rate, super low payment, lower than they'd ever get qualifying on their own. Despite having perfect credit scores, they actually give them a lower interest rate with the bank. Year and a half later, after they built it out, they started renting out those units. They went back to the bank. They said, hey, can we take the lien off of our life insurance? And the bank said, yeah, looks like the value's in the building now, so we'll take it off and keep your same terms. So they still have this super duper low interest rate that they can never get again, and a low payment. They're only paying like $1,800 a month on this building that they spent almost $400,000 on. And voila, they now have this building that's super cash flowing for them right now, all because they just use this as collateral temporarily. You can even pay off your own loans. If you have high interest credit card debt, you can use it to pay that off. I don't recommend you buy cars with this. Like many people, if you ever watch YouTube on the infinite banking concept, they say buy your houses or cars with that. Don't do it. Unless interest rates go ridiculously high, I would not recommend that at all. I would rather leverage the bank as much as I can, use their money to get these assets. And then, of course, anything that I can't use my money for, or something that would cost me a lot more money from the bank, like a credit card type of interest rate, that is when I use this policy for that. And of course, there's even extra retirement income, which is what a lot of people talk about. Notice I didn't even mention anything about that, but yes, it could be part of your tax-free retirement that helps supplement you. I even know a guy, he's a money manager. He actually used a strategy. He said, yeah, this is the best thing ever. He's like, I'm putting my money in for 20 years into this policy. It was with MetLife. And I said, oh, that's one problem. MetLife's not a great company to use. But he's like, I'm putting in for 20 years, and then I'll live on this tax-free pension for 10 years, as he's pulling out the money. And so I said, well, really, what do they show you? And so he was putting in $20,000 a year. And then after paying out the 400,000, he was going to pull out $60,000 a year. Right. So put in 400,000, pull out 600,000. Not bad. I showed him, I said, listen, if in the meantime, instead of doing that, you actually took that money and do the exact thing you do, which he usually buys real estate, like commercial real estate and different projects that way. Instead, just take that money and make a very low return for him, like only like 10% return. I said, what would happen is you would be leveraging this policy. You would still have a bulk of your money in there. You could pull out $58,000 a year from your policy, and you would have about $120,000 a year coming of passive income from your investments. So I asked him, I said, Mike, that's his name, Mike. I said, Mike, would you rather have $60,000 a year tax-free or $58,000 a year tax-free plus no taxes on his real estate for $120,000? That's $178,000 tax-free or $60,000 tax-free. What would you want? He's like, triple his income, of course. And the sad thing is he's a brilliant man, brilliant money mind, but he never realized you could do that. It's not complex, but sadly, you just don't get people that in the insurance industry that think like investors. They don't think creatively. They just think the way that they're taught to think, which is what the insurance companies want them to do. You don't want that. So, all right. So this time I'm going to open up for questions right now because that's about all I have. So let's hear what you guys have right now.
Well, thank you very much, Chris, for joining us. We greatly appreciate the opportunity to have you share your expertise with our audience. Obviously, we are big believers in the strategy, in what you do. It comes in very handy. Again, depending on how your personal financial situation is, that policy can vanish from some financial aid equations, thus effectively allowing you to be eligible for more free money for college. We would certainly urge you to talk to Chris and myself if you have high school age kids or kids you're planning on sending for college for that strategy. On the investment side, obviously has a great way to give you access to the ability to put away more money than you could in, let's say, an IRA, and of course, get it out tax-free and not have to wait till you're 59 and a half if you do it right and have a properly structured policy. Super important to talk to Chris over at Money Ripples to make sure it's done correctly.
Absolutely. Well, Seth, any questions from you? I know Danielle's fielding questions right now as well.
Awesome. I do not have, I have one, but I'm going to ask it off air because it's a more advanced strategy that is separate.
Cool. Well, that sounds exciting too. Now I want to know it.
I'll send you an email.
Yeah, sounds good. The one thing I think I'll bring up and reemphasize again, that I think is really important to understand is that, we can't tell what the future is going to hold, right? We try to plan our kids' future, but I'll tell you, I mean, with my 8 kids and what I've seen, my oldest just turned 18. He's graduating high school next week. And he's definitely not taking a path that I would have predicted when he was a little kid. Heck, not even the path I predicted when he was 13, 14 years old. And I'm seeing that true with most of my kids. We just never know what's going to happen. Heck, I mean, if I actually went with my childhood dreams, I would have been either an astronomer, a physicist, maybe an astronaut, right? I would have been doing some of those things. That was some of my dreams I remember in 6th grade, a girl was trying to, she was, I didn't realize at the time that was considered flirting, but, I was oblivious to the fact. I remember she was clawing and trying to hold me back as I was trying to get away from her. And I said, I got to get away. No, I still have to go to college and be a physicist. Like what kind of nerdy 6th grader said that, right?
That's impressive.
Yeah. And I ended up going to sociology, and I didn't even know what sociology was my senior year. I just knew it was like psychology for groups. That's all I thought about. Right. It was just the thing I wanted to go into. And that led me down this financial path that I'm in today. And now that, really that college funding wouldn't have been as useful because I didn't go into my MBA or graduate stuff. It would have been better had I had some extra cash that I could have used to really help me start my business, launch it, and where I was bootstrapping it and doing it cheap and doing it the long, hard way. It would have been so much nicer to know I had access to cash to use for a variety of reasons versus just my college.
Absolutely. I agree 100%. All right. Well, thank you so much for joining us and sharing your expertise. Thank you, everybody, for being here. Chris, how do they get in touch with you if they want to learn more?
Easiest way, you can just go to moneyripples.com. We even have a playlist called Infinite Banking. You can actually see other YouTube videos on the concept, but obviously you've already learned more than most of those videos anyways. So you just go to the contact us page and reach out to us there.
All right. Awesome. Thanks everybody for joining us. Go check out moneyripples.com.